If you open any financial app in 2026, you're bombarded with a constant stream of the next big thing. AI infrastructure, energy pivots, or the latest crypto rebound. For the novice or intermediate investor, it feels like you're standing in the middle of a hurricane of information. But true wealth isn't built by chasing the storm. It's built by creating a structure that can withstand it. Today, we're moving away from the hype and going back to the fundamentals. We're talking about the complete architecture of your money, from the psychology of your monthly budget to the high-level math of global asset allocation. This is your 2026 financial blueprint. Let's start with the most misunderstood word in finance: budgeting. Most people think a budget is a cage, a list of things you can't do. At Wealth Beyond the Paycheck, we see it as a map for your financial offense. To create a budget that actually works month over month and year over year, you have to move away from rigid perfectionism. We recommend starting with the 50-30-20 rule: 50% for needs, 30% for wants, and 20% for your future. But here's the secret to long-term maintenance. Celebrate the small wins. If you stayed under your dining out budget this week, acknowledge it. If you found a way to cut a $20 subscription, that's a win. Review your numbers on the same day every month. Look for budget creep, those tiny expenses that slowly expand over the year. By being flexible but consistent, you turn budgeting into a habit rather than a chore. Don't beat yourself up if you have a bad month. Just recalibrate and start the next month fresh. A budget that is too rigid will eventually break. A budget that flows with your life will build a fortune. Once your budget is flowing, you need your shield, the emergency fund. But we don't just want a lazy pile of cash, we want an active shield. Building this doesn't have to happen all at once. Look for creative, small ways to feed the fund. Set up a roundup feature on your debit card. Redirect your small wins from the budget directly into this account. If you sold something on a digital marketplace, that money doesn't go to a steak dinner, it goes to the shield. Why does this matter? Let's look at a real-world example. It's a Tuesday night and your refrigerator dies. A new one is $2,000. Scenario A, you have no fund. You put that fridge on a credit card at 26% interest. Over 2 years, that $2,000 fridge actually costs you over $2,600, and the high monthly payments eat your ability to invest in your future. Scenario B, you pull $2,000 from your active emergency fund. You pay cash. You have $0 in interest, and you simply spend the next few months refilling your shield. The difference isn't just $600, it's the psychological peace of mind of knowing that an emergency is just an inconvenience when you have a shield. Now we move to the engine room, asset allocation. In 2026, a robust portfolio must be geographically and sector diverse. This is about investing across asset classes and within them. You must invest across asset classes: domestic equities, U.S. stocks, your primary engine for growth; international developed equities, stable economies like Western Europe and Japan to hedge against a weakening dollar; emerging markets, high-growth economies like India or Brazil; fixed income and real assets, bonds for stability, and commodities to hedge inflation. But here is where we level up: liquid alternatives and hedge fund strategies. Traditionally, hedge funds were only for the ultra-wealthy, but today, liquid alts allow you to access these strategies through standard ETFs. These products use techniques like long-short or trend following to make money regardless of whether the market is going up or down. Why do we use these? To strip out idiosyncratic risk. Idiosyncratic risk is a fancy term for specific risk. It's the risk that one specific company fails, or one specific CEO makes a bad move. If you only own one tech stock, you have high idiosyncratic risk. By diversifying into liquid alts and global markets, you strip that away. You aren't betting on one horse. You are betting on the entire system of global growth. To make this actionable, use the 3-bucket system. Bucket 1, safety, is your emergency fund. Bucket 2, stability, is your core. Broad market index funds and your liquid alts. This is 85% of your wealth. Bucket 3, opportunity, is your 15% satellite. This is for high-growth AI infrastructure or specialized plays. This prevents emotional investing. If the opportunity bucket has a bad week, you don't panic, because your safety and stability buckets are untouched. It allows you to be aggressive where it counts and conservative where it matters. All of this leads to your financial blueprint. Think of this as the architectural drawing of your life. The most critical component is your time horizon. This is the amount of time you have before you need your money. A 25-year-old has a long time horizon. Someone 5 years from retirement has a short one. However, even with the best blueprint, you need a lead architect, a certified financial advisor. A professional advisor doesn't just pick stocks, they guide you through tax optimization, estate planning, and rebalancing. They act as a guardrail against emotional mistakes and ensure your satellite strategies don't accidentally swallow your core stability. A blueprint gets you started, but an advisor ensures you finish. Building wealth in 2026 isn't about being a genius. It's about being an architect. Every dollar has a job to do, defending you in your emergency fund or growing for you in your global allocation. Start today. Refine your budget. Feed your shield. Balance your buckets. Stay disciplined to your blueprint and your time horizon. This is how you move beyond the paycheck and into a life of true independence. If you're ready to build your fortress, subscribe and join our community. Let's get to work.